Supermicrocomputer and Oracle are benefiting from the rising demand for artificial intelligence. Revenue for Supermicrocomputer is soaring, and orders for Oracle's performance is also increasing. But which one of these AI stocks is the better buy? I'm going to answer that question in this video, comparing these two AI stocks across a number of critical financial categories, including valuation. Of course, I won't neglect the recent developments at Supermicrocomputer with all the question marks surrounding its financial statements and the integrity of management's transparency in reporting the financial results to investors. I'll keep that in mind and I'll allude to those factors when making this comparison. So let's compare these two.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So looking at revenue growth, you notice that Supermicrocomputer has exceeded Oracle for the better part of the last decade in terms of revenue growth, and especially in the last year and a half or so, as sales for Supermicrocomputer have soared. Supermicrocomputer helps businesses build data centers optimized for artificial intelligence because these data centers require, well, I shouldn't say require, but because they consume so much more power, liquid cooling solutions are higher in demand, and Supermicrocomputer specializes in delivering liquid cooling solutions, which lowers the cost of cooling these highly accelerated graphic processing units. That's why its sales have exploded. Oracle, meanwhile, only grew revenue by roughly 7% in the latest quarter, but orders for its services are exploding, and management has highlighted that revenue growth is likely to accelerate over the next 4 to 12 quarters as the company starts to deliver on those orders, on those backlog of orders, which are increasing by the tens of billions of dollars. However, if we look at operating profitability, it's a completely different story with Oracle in the huge lead here with 31% operating profit margin over the trailing 12 months and Supermicrocomputer at just 8.5%. Now, Supermicrocomputer's operating profit margins are declining in recent quarters as management talked about needing to lower prices so that they can gain early market share in this highly competitive industry with rivals like Dell and Hewlett-Packard Enterprises offering competitive prices as well. Longer term, you can see Supermicrocomputer has never generated an operating profit margin even over 12%. The industry overall generates profit margins in this range. It's not a very profitable industry. Whereas for Oracle, it demonstrates very strong operating profit margins, and its industry overall, it's more profitable than Supermicrocomputer. Similar story when we look at cash flow from operations to sales, but it looks even worse for Supermicrocomputer, which has been negative in recent quarters. Now, I talked about in several videos why Supermicrocomputer's cash flow from operations are negative, and it has to do when you're a fast-growing business that sells hardware, that your cash flow from operations can turn negative because you build up inventory and you sell that inventory and you pay for a lot of those costs before you recoup the money from the people that you sell it to. In business-to-business sales, there's usually a time allowance for repayment. So when Supermicrocomputer makes a sale and makes an installation, it could take 30, 60, 90, or 120 days for Supermicrocomputer to get the payment for its services. Now, negative cash flow from operations because of rising revenue is okay in most cases, but it's especially concerning for Supermicrocomputer because it's having those financial statement difficulties. It's delayed its financial statements. Its accounting firm stated that the management team has not been transparent and honest with them, so they resigned. And so now they finally got a new auditor and they released the results of their internal investigation saying they found no wrongdoing, but still questions remain. And when you have negative cash flow from operations, that really raises question marks because you can report that your sales are exploding and your profits are exploding. But when there's negative cash, it raises the question, well, what's going on there? If your sales are increasing and your profits are increasing, why is your cash flow still negative? And part of that can be explained by the timing differences between accounts payable and accounts receivable. But that's one area where companies have been uh, able to manipulate financial statements to some degree and capitalize on that time lag between accounts receivable and accounts payable for inventory and installation. So, in and of itself, a negative cash flow from operations from a business that's growing revenue that quickly is not a concern. But when combined with the question marks surrounding the transparency and quality of the financial statements, that is a major concern. So, that's something that investors in Supermicro Computer should consider. Meanwhile, Oracle, 35%, it's an excellent cash flow from operations to sales without those financial statement concerns. So, huge advantage to Oracle in this head to head comparison on cash flow from operations. Return on invested capital measures the profits that a company is able to generate from capital that it gets from investors. This is a core skill. Supermicro Computer in the recent 2 years or so, this metric has exploded for them because they're reporting soaring revenue and soaring profits. And so, if those numbers are accurate and they don't need to be restated, then these numbers are excellent for Supermicro Computer. While Oracle is a lower number at 11.65%, that means the company is able to generate strong operating profits and cash flow from operations, but it's having to use more investor capital to generate those profits and those cash flows. So it's investing significantly in capital expenditures to have the capabilities to deliver those services that generate those high profits and cash flows. And finally, I wanted to compare these two on valuation, and you can see these big changes for Supermicro Computer. It started off the year as one of the most popular AI stocks in the market with a forward PE multiple that rose above 30. And if you recall, around this point in time, around March, I told investors it was a good time to sell Supermicro Computer stock and take profits because the valuation was getting ahead of itself. Then the company's stock price really took a hit, starting to dive all the way down here. And recently, it's caught a bid here and it's up to a forward PE of 11. This is right about its historical average forward PE valuation. This is around the range where the stock should trade at realistically without all the hype and enthusiasm for artificial intelligence and the super growth rates in its revenue over these recent quarters. Oracle, meanwhile, trading at a forward price to earnings of 26, its valuation is also higher on the back of enthusiasm for artificial intelligence and those rising orders that investors are correctly anticipating will turn into accelerating revenue growth. So if I was to pick one of these two AI stocks today, I would pick Oracle because the company's performing excellently in recent quarters. Demand is growing by the tens of billions of dollars, and it doesn't have the question marks about management and financial statements quality as Supermicro Computer does. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock. And this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.